Hey guys, well, welcome back and thanks for checking out another video for Neely Property Investments. I was just looking at this property, 7 units in a good location in Boise, Idaho that's growing like crazy. And I decided this is not a good fit for my investment portfolio. And I just thought it might be interesting to share why it's not a good fit. So I'm going to go through that now. This is a 7 unit apartment building, so on the smaller side, but still considered commercial property, generally sold off of a cap rate. Like I said, it's in a pretty good location, kind of near southeast Boise, which is growing like crazy. Right off the bat, though, they're asking $2,065,000. The NOI, which is the net operating income, is only $92,000. You know, it's a 4.7% cap rate. So if you take those two numbers and you divide them, that is how you get the cap rate. So that's would be your return if you paid all cash for the property. If you paid 2,065,000, you'd be earning 4.7% back on your money, which already isn't great. There are tax benefits and appreciation, all these things, but that return, especially in today's environment, is not great. Also take into account that this says it's a pro forma NOI, which means that it's an estimate from the broker or the seller. So generally these are overly aggressive. They're not reality. I mean, maybe in a perfect world they could work out, but not how it usually works. So without getting into too much of the condition of the property, because it is older, and would likely need some renovations to be getting top rents. Got laminate counters. Does look like nice hardwood raised panel cabinets, linoleum floors. So, the pictures they took are probably one of the nicer units. Looks clean, but, definitely like a Class C. If we look real quick at the OM, we got 7 units. Interesting, they have offering price here of 1.975. So I don't know why that doesn't match their Crexy ad there. Some more photos. Probably can get some income out of the garages. I don't see that on the rent roll, so they may or may not be charging it. This is their financial summary, so these are their in-place numbers. This is an old financials here, but so they're showing net operating income is 79,000. So that's what they're actually doing. Maybe you can get it to 81 if you use their in-place rents with some of these historical expenses, but their annual income they're claiming is 92,679. So if I do a calculator here real quick and we do 81,435 divided by 2.065, actually a 3.9% cap rate. I can literally go put my money in a savings account, FDIC insured, and earn more than 3.9% right now. So this is why a lot of these smaller deals don't pencil. And it's really hard to change that when you only have 7 units. You really have to start charging a lot more in rent to get, to get that to move. When you have 20, 50, 150 units, then it starts really being at a scale where you add $10 a month or $25 a month, and that compounds to be hundreds of thousands of dollars in value added. These rents already look like they're pretty solid at market just from knowing the area. I don't know what they're forecasting they can get them to, but for a 2 bedroom, 2 bath, yeah, 1,650. It looks like they have one at 1,730. So I don't think there's a lot of room to push rents up either. So you're going to be in a 100% negative cash flow situation because your debt, if you're going to leverage this property, is going to be at a higher rate than your cap rate. So that means that you have negative leverage, which I don't do that. You want to be benefiting some from the risk that you're taking with the debt. So just a couple other takeaways here. I punched this into my just my little spreadsheet that I can do here in 10 minutes. Repairs and maintenance are pretty high, and that's probably because it's a 1991 property that hasn't been renovated. So maybe they've deferred maintenance and it's catching up with them. I don't know. The other thing is the insurance, which is typical on a smaller property like this, but $800 per unit for insurance. If you get into a bigger property, 30 plus units, you know, 300-400 bucks a month in Boise, you typically can do. So there's a lot of things going against this property here. The If I underwrite it at my expected expenses and income, I'm at 73,000. And if you put a reasonable cap rate on that, if it was a larger deal, you're at 1.2 to 1.3 million is what this would make a good investment. Them wanting over two or just under two doesn't make any sense, and that's why it's sitting on the market um, for 430 days. So maybe they'd be opening an offer. I don't know, but this one would be down at 1.2, 1.3. And then even then, it's not. I'm not super interested because of the scale that I was talking about, where you can't really grow it. There are some good things to it, but not much. We're near the in-place rent to the average median income kind of limit that's comfortable. You could push those a little bit if the market would support it, and it's really not that far below going and buying your own home and paying a mortgage. So yeah, that's I didn't get into these other calculations yet because it just didn't really make sense. So I thought I'd just record a video real quick, and you could kind of look over my shoulder and how I look at a property. And next time I'll try to do a little bit larger property. But hope this was interesting. If you'd like to learn more about investing in real estate or potentially participate alongside me as a passive investor in some of the bigger properties that I'm doing, feel free to check out the links below. I put together a full due diligence center that has a lot of information on my track record, my philosophy, and it's where deals will pop up if we have something in the works. And make sure you're on the list. Feel free to shoot me an email or reach out if you ever have any questions. Have a great day.